All right, we're going to get started here. Welcome everyone to the CARW Thought Leadership Series. This is our fourth and final program of this series, the Macroeconomic Outlook. Programs like this are only possible because of our wonderful sponsors. The series sponsor for the CARW Thought Leadership Series is Landmark Credit Union.
Landmark Credit Union is honored to be the presenting sponsor for CAR's new Thought Leadership Series. Today, all CAR members, including brokers and affiliates, are affected by COVID-19. This challenge, like all previous ones, presents new realities and opportunities. For Landmark, we faced one reality that business lending would be managed remotely, but an opportunity to increase the use of digital signatures and contactless closings. Across the company, several innovations created to serve members had a positive outcome and will remain as permanent options. I am excited to hear about more creative ideas presented in the Thought Leadership Series from companies, industry experts, and economic analysts. I hope this series provides all of you with new opportunities that can be derived from today's reality.
We're also grateful for all of the CARW 2020 annual sponsors listed on this screen. Today's program will be moderated by the 2019-2020 CARW Chairman, Joe Locke, who is a principal at Colliers International. Today's presenter is Noah Williams. He is the founding director of the Center for Research on the Wisconsin Economy, also known as CROW, and the Julie Plant Granger Professor of Economics at UW-Madison, where he has been on the faculty since 2008. A native of Menominee, Wisconsin, he was previously on the faculty at Princeton University. His research focuses on macroeconomics, particularly monetary policy, social insurance programs, and financial markets. He is widely published and a tremendous asset. He is a graduate of the University of Chicago. He is a consultant to the Federal Reserve Bank of Chicago and a member of the Economic Advisors Roundtable organized by the WMC and WEDC. His research on state economics, which underlies the work of CROW, has been supported by a grant from the National Science Foundation. Today's program will be around 45 minutes. We'll take 35 minutes of predetermined questions, and then of course, always invite your questions. So type them in the chat function, text them to me, email them to me, and we will make sure that they get we'll conclude around 1:45. This program is being recorded and will be shared tomorrow morning. And now I'm going to turn it over to Joe Locke.
Thank you, Tracy. And Professor Williams, thank you again for being here today. It's an honor to have you with us. I'm excited to jump into a great conversation. So starting out with your ongoing work at CROW, you have been tracking the impacts of COVID-19 across the state of Wisconsin and nationally. And we'd really like to hear your take on what it has done, what it has impacted within our state's economy.
Okay, so first let me say I'm happy to join you all, and really been looking forward to this discussion. So in broad overview, one of the things that we've been doing at CROW, particularly since the pandemic started or really hit the state in the middle of March, has been trying to track in real time using some new economic indicators to try to get a sense of the scope and the magnitude of the changes that we've seen in the economy, which are really unprecedented at this time. So a couple of the indicators we've been looking at include filings for unemployment. One of the primary changes that the pandemic has brought on has been mass unemployment. We saw beginning in the middle of March, we saw a huge spike in unemployment filings, initial unemployment claims. Whereas the stock of unemployed workers coming into this, the unemployment rate in the state was roughly about 3%. within a couple of weeks, we'd seen more than double that amount filed for unemployment insurance. So just an unprecedented huge spike in unemployment, which again started in the middle of March and continued, really hit a peak around the middle of April. In addition, we've also been looking, because it's really hard to get a sense in real time of economic activity, spending, output, production, things like that. One of the things that we've been tracking are measures of foot traffic. So this is just based off following people, locations from GPS in cell phones. So this is a company called SafeGraph, which provided us this data, a relatively large sample, roughly 10% of the state population. And what we saw was really, again, starting in the middle of March, we saw a very rapid and very large decline in economic activity. So year over year, we saw overall economic activity or overall foot traffic fall by about 60% by the middle of April. So we saw mass unemployment. We saw a huge slowdown in economic activity. And then as official data has come out with more of a lag, we've seen a lot of this actually then been verified. We saw the state unemployment rate, the official unemployment rate, go from roughly about 3% to 14%. We actually think that's an undercount. We can talk about some of the issues involved. It's actually really difficult to even measure unemployment properly in a situation like this.
Sure.
So really we kind of, again, it was really unprecedented, both the scale and the speed at which things changed. We roughly hit bottom, I want to say around Easter Sunday in the middle of April. And then we've seen a bit of a bounce back since that point. We've seen businesses which were closed. At one point, we have, again, another data source on hourly workers and businesses that employ hourly workers. Roughly 40% of these businesses were closed. Since the middle of April, that they've come back, and we're now only down about 10%. We've also seen nationally last month, the consensus projection was that employment would continue to plummet. Instead, we saw unemployment bounce back with, again, still being far down year over year, but with 2.5 million new jobs added and the unemployment rate falling. Also, with our measure of economic activity by foot traffic, we have data through the middle of June. I think June 7th was the last data point we had. And where at one point we'd been down 60% year over year, we're now down about 20%. So we've regained a significant amount. So as first, while the safer at home order was still in place, but some of the restrictions were eased and more businesses adapted through curbside pickup, retail with lower capacity. And then even more rapidly since the Supreme Court decision invalidating the safer at home order, we've seen a pretty substantial bounce back in economic activity in the state. We're still well down, but we're also well off the lows, which we'd seen earlier in the month.
Well, that's certainly great news. Pivoting it, I suppose, federally and taking some of those numbers and looking at them a little bit differently. You know, you said we went from 3 to 14% unemployment in the state. What does that equate to in numbers of jobs actually lost?
So the labor force in the state is ballpark about 3 million people. So you want to think about roughly a 10 percentage point increase in unemployment. So we're looking at roughly 300,000 jobs lost. And again, this was, like I said, there's measurement issues there. If you actually looked at, not to get too into the weeds, but there's the payroll survey, which they actually measure from businesses reporting who's on their payroll. The last state level data we have is April. There we'd actually seen 15% of jobs lost. So even more than that, relative to the household survey, which was only reporting, roughly this 10 or 11 percentage point increase.
When we speak to the recovery of those jobs, do you anticipate we'll come back in full force to unemployment numbers as they were previously, or do you think that will take some time to get us back to
I certainly think it'll take some time to get us back there. There's kind of two issues going on. First, as we've seen, there's been a rapid bounce back just as we've reopened, and many businesses have opened back up. But there's also been a reallocation of economic activity, both in consumer spending. Right, so restaurants are still way down and are likely to stay way down, whereas people have shifted more towards spending on groceries. So this means that, and moreover, many of the temporary layoffs have actually become permanent. So the hope early on was that we would have a relatively short shutdown where economic activity would cease, but then we'd be able to rapidly reopen up. We are reopening up, but whereas initially the hope was that, or the estimates were that roughly 25% of the unemployment would be permanent, we're now expecting something closer to a third to 40%. So I'd expect this big bounce back, but to tail off because again, there's a number of industries, travel, tourism, basically any kind of leisure and accommodations, where as long as the virus is still out there, people are going to be reluctant to resume their level of activity that they engaged in earlier in the year.
Certainly. Related, but probably taking things to the next level of conversation, we started with a health concern in our nation with COVID. Then we saw an economic stoppage from it. And certainly we have also uncovered some significant racial issues and that need to be addressed in our nation as well. Seeing all three come together at once has a profound impact socially, economically as well. Have you seen any indicators, or are you starting to track anything relative to what's happening globally with everything that's happening?
Yeah, so there's certainly kind of a compounding effect, and there's also a big distributional effect in all of this as well. So first off, just kind of broad level, talk about the compounding, right? So there was initially a lot of the declines in activity we saw were just due to the virus, right? So before there were any official government orders, stay-at-home orders, or shutdowns, or any kind of lockdown orders, people voluntarily cut back on travel, tourism, hotel bookings, restaurant bookings were all way down well in advance of any government orders. Then the government orders essentially locked us into a lower level of economic activity for a while, and then just as we've started to come out, there was the protests, which increased in some levels, increased activity, right? We've seen more people out in the streets, but also we've seen, at least initially, that we seem to be kind of beyond this. This also meant that some businesses stayed closed for a longer period of time. That seems to be a relatively shorter, less severe phenomenon. What is also striking distributionally is that, again, it's often what we see in a recession, but it's particularly stark here that there's been big distributional effects, meaning that many of the lower income, both communities and individuals and industries, have been hit the hardest. And this also then has a racial component to it. So roughly, less than 7% of the population of the state of Wisconsin is African American, but we've seen over 20% of COVID cases in this population and 24% of deaths. So again, it's not, there's been big impact overall across the state, and everyone has been impacted, but some communities have been particularly so. We've also seen nationwide, the African American unemployment rate has increased by much more than the overall unemployment rate. And then even in May, when the overall unemployment rate fell, the African American unemployment rate ticked up. So both the recession and then the the disease, the pandemic, have actually exacerbated some of the pre-existing inequalities.
Well, clearly there's work for us all to do as a society to rectify some of those. Looking back to the beginning of the pandemic, we saw the federal government step in with an economic stimulus package, the likes of which we have not seen in the recent generation. It was effectively a lifeline to bolster consumer spending rather than a stimulus package.
Yeah.
From your standpoint, has it worked? Has it fallen short? Did we kick the can down the road? What is your take on the approach that was undertaken?
Yeah, so there were really three main programs, which I think have been the most influential or had the biggest impact. The first was the direct payments, the stimulus, or I really think of them more as relief payments, the direct payments to individuals. The roughly $1,200 checks.
Mm-hmm.
Those have helped prop up consumer spending in a period in which a lot of economic activity has been halted.
Mm-hmm.
We saw consumption, spending, and income increases were much higher than anticipated over the last month. So they've helped on that dimension. And the other two programs that I want to highlight are the increased federal unemployment benefits. The federal government basically topped up state level unemployment benefits with a $600 per week payment. In a period of mass unemployment, this has certainly helped. Previously, in Wisconsin, for instance, the so-called replacement rate, how much you get in unemployment benefits as a share of what you earned while you were working, was roughly about 40%. With these federal top-ups, average replacement rates have now been closer to 90%. And in many cases, people are actually earning more in unemployment than they'd have while they were working. That has both pluses and minuses associated with it, and we can talk about some of that. But nonetheless, it's basically propping up or providing a lifeline to unemployed workers. That's certainly been effective. The third main program is the PPP program aimed at small businesses. I think that's one of the main reasons why we did see employment nationwide come back last month, whereas many analysts had been projecting a further substantial decline. We actually saw an increase in payroll employment as many of the small businesses, the PPP loan forgiveness was tied to keeping people on payroll. So many businesses were able to do so, and we're actually able to bring back some workers. So I think along all these lines, the programs have been relatively effective. There's a question now, in the midst of the pandemic, we didn't worry so much about incentives. And what would these mean going forward? It was basically get as much money and relief out the door as fast as we can. Going forward now, as we emerge from the lockdowns and the economy picks up, I think incentives and the overall scope of the government programs come more into play. So
as a follow-up to that, we have historically low treasuries. We have massive quantitative easing as well. In addition to the stimulus, the unemployment benefits, and the PPP, what arrows are left in the quiver of the federal government, if any?
Yeah, so a couple of things. So there's, first off, there's at least initial discussions about another round of stimulus/relief checks. The fear is that a lot of these programs are essentially ending in July. And the economy has started to recover, but we're certainly not out of the woods. So if we pull back a lot on fiscal spending, that this may lead to more of a contraction. The other main program, which is a little bit controversial, but is also under discussion, is aid to state and local governments. The federal government is able to borrow at relatively low interest rates. States and municipalities are essentially required to run balanced budgets. So in a time like this, when revenue has been compromised significantly, if they're not provided with some additional resources, or essentially the federal government basically doing the borrowing for the states, that would mean that they would have to cut back substantially on services. There's political issues there because many states have not been the most fiscally responsible, and we don't want to necessarily provide a blanket bailout. But there is perhaps a role for at least replacing some of the revenue which would have been lost due to the pandemic.
Okay. Pivoting a little bit and back to the unemployment discussion. Federal Reserve Chairman Powell recently predicted the unemployment rate will likely remain high for years. Conversely, President Trump is stating we're likely to see a V-shaped recovery with a rebound in 2021. From a macroeconomic perspective, what's your take on that?
Yeah, so I think what we will see is we'll see a continuation of the relatively sharp rebound, but then that will taper off. So I think, again, we're coming from a very low level, right? So, 14% unemployment is, even in a recession, is abnormally high. We came down to 13%. I think we'll drop a little bit lower than that, but I don't think we'll get back to where we were, earlier in the year anytime soon, because of these underlying both shifts in the economy and the fact that many of these short-term business closings have turned into permanent failures. Again, particularly in sort of the leisure, tourism, hotel, restaurant industry. So I would expect certainly a recovery from where we've been, April, again, being roughly the low point. But I think after a relatively quick initial bounce back, things will slow down and we'll see continued recovery, but it will take probably, maybe into 2022 or beyond before we would get back to where we were earlier this year.
Outside of the reference to hospitality, leisure, and retail, are there specific other areas of the economy that you have seen most impacted by this, and that we can expect a longer recovery on? So there've been particular, sorry, let me step back. There's been the pandemic has shifted, again, this is particularly in retail, but it cuts across different sectors, has exacerbated or accelerated the shift towards online and remote work. So certainly that hits home in retail. We've seen a bounce back in consumer spending, but less at in-store transactions, right? So consumer spending has risen, but a lot of that has moved online, which also means a big shift across retailers. So instead of the local retailers, local businesses getting sales, things are happening more at the national level. So Amazon has been a big beneficiary, whereas local small business retailers have likely not bounced back. So I think that would point towards overall more concentration. We've seen that kind of increasing concentration, meaning larger businesses getting bigger and commanding more market share. I think that's going to be true across the board. There's also been a shift towards, at least for the near term, towards remote work in business services. I expect that to continue, and that will have sort of reverberating effects on commercial real estate, for instance. Let's chat a little bit about the equity markets. The Dow Jones saw a 25% dip basically at the end of Q1, beginning of Q2, but seemingly is bouncing back quickly. However, the fundamentals, the company earnings that are intended to support those valuations don't seem to be there yet. What What can we attribute this to? I mean, is it excess capital on the sidelines that's just looking for a place to be? What do you see happening throughout the balance of the year?
Yeah, so I think, I mean, as always, explaining the stock market is difficult, and if I were able to do that with with sufficient accuracy, I probably wouldn't be with you here today. But I think there's a few factors. Yeah, first off, as you mentioned, interest rates are low and are projected to remain low for an extended period of time. So there's a search for yield, a search for returns, which naturally pushes more money towards risky securities. And again, I think that's been the case for a number of years. And again, I think the Fed is. They said they're not thinking, and they're not thinking about increasing interest rates. So second level rationality. In addition, right. So the thing to remember, of course, is the stock market is forward-looking. It responds to current conditions, but more as a signal about the future. So to the extent that we, this week we saw a large rally with the retail sales numbers, which came in above expectations, showed a sharper bounce back. All of that's kind of signaling that maybe we'll have a more rapid recovery than perhaps analysts initially expected. I think another component, though, which goes along with some of the concentration issues, but which I mentioned earlier, but which often doesn't get noticed so much, is that a lot of the stock market indices now are driven by the performance of a few large firms. So even though we talk about the S&P 500 or the Dow Industrial Average, it's really a few of the largest companies that are having by stock market valuation that are really driving that. So things like Amazon, Apple, Google, all of which have performed better than the overall economy in this recovery. Again, as we've had more move to online, more move to remote work. So I think if you look not at evaluated, but just look at numbers of stocks and look at their performance, I think you would get a different picture than looking at these valuated measures that we usually look at. So I think the concentration particularly of larger firms, which are more in information services, which in general have performed better, also points toward, is one reason why the stock market indices have rebounded more than we might expect.
Interesting. Okay. I want to bring it back to the state of Wisconsin for a second and speak to tourism. You touched on it a little bit before. Clearly, it's a large driver of our state's economy, specifically in the northern half of the state. Presumably, we have a beautiful summer ahead of us. Do you see that rebounding? Do you see the tourism industry being one of the first to help lead the hospitality industry out of the effects of COVID?
So again, I would expect certainly a rebound from where we've been, and we've seen initial stirrings of that, initial indications. But I would honestly, I would expect things to remain relatively muted, not to get back certainly to where we were. Again, think about just regionally. Like you'd mentioned, a lot of the northern parts of the state rely on seasonal activity and tourism. And these regions, these areas of the state have actually been among the hardest hit by the recession accompanying the pandemic. They also tend to be lower, have lower average incomes. So again, that kind of goes along with the general finding that lower income individuals and locations tend to have fared the worst. So I think we will see a recovery, but it's also, there's a question about, if hotels and restaurants open up but have restricted capacity, will they be able to raise the same level or anywhere near the required level of revenue that they were raising previously? So again, I would expect to see a bounce back, but still activity or revenue to remain down.
Okay. Professor Williams, I want to be respectful of your time here. I feel like you and I could chat. I'd love to continue asking questions of you for the next hours. But there are a couple of items I'd love to jump to, and I think you alluded to it as it relates to restaurants, right? Restaurants are open back up, but they have limited seating capacity. How does that change things for them? What do you think we face if there is likewise a relapse of the virus this fall? You know, we get a nice hiatus through the summer months and it comes back. What does that do to the shape of the recovery we can anticipate?
Yeah, so I think that's probably the biggest risk going forward. We've certainly seen, there's been indications, again, it's a little bit difficult to sort out. Looking at other states, we've seen some spikes in cases of some of the states, particularly in the South and the West, that have been more aggressive in reopening. Again, looking at cases is a little bit ambiguous because most states are also ramping up testing. But it does seem to be that there's been an increase in, say, Arizona and Florida in not just cases, but also hospitalizations. And that has meant that a number of states have paused their reopening plans, and locations are introducing more restrictions. So I think that's, you know, on the other hand, we've actually performed relatively well so far. So since reopening, cases have continued to come down, hospitalizations have continued to come down. But again, that's clearly a risk, and most epidemiologists are predicting that there will be a second wave in the fall. Again, not an epidemiologist, but I think that that does seem to be a likely possibility. I don't think we'll see anything like the mass shutdown which we had in the spring. Instead, we'll see more targeted restrictions, trying to isolate particular locations. Also, more restrictions, again, on certain types of activity, protecting nursing homes, and again, ruling out or being slower to get back to some of the larger scale gatherings. So I think that a large sort of second wave could certainly slow down the recovery substantially, turn it from something like a check mark shape where we're having this very rapid initial fall and then the slow but continual recovery into something perhaps with a second downturn. So again, I think it's a real concern. We of course we hope that it doesn't come to pass, but it's certainly something on everyone's mind.
Certainly. I think it's easy to assume that a vaccine is our answer, but being pragmatic, realize that a lot of the damage, if you will, that's happened already is somewhat irreversible. Have you looked into this personally? Has this been a discussion topic at all to understand what a vaccine may do to the shape of a recovery, or the timeline associated with it, or the impact of it?
Yeah, so I think, again, of course, everything depended on when it would come in, but I think it would certainly accelerate the recovery and bring about a more rapid return to something which, again, closer to where we were, or perhaps even beyond that. Again, lots of conditionals there. How quickly does it come? How quickly are we able to, ramp up production and distribution of the vaccine? How many people take it on, and so on. Mm-hmm. So, that's the hope. Of course, right now we have to try to learn to live with the virus and get by as best we can in coping and trying to minimize risk in the meantime.
Certainly. So speaking of risk minimization, what's the latest and greatest, if you're able to share, from UW on what the plan is for fall and bringing students back onto campus?
Yeah, so there was earlier, or perhaps last week, there was the general UW system announcement, and then actually just today, Chancellor Blank made an announcement about the resumption of plans for UW-Madison. So UW-Madison and all of the UW campuses are going to be returning to face-to-face instruction with some modifications. So what that means is UW-Madison in particular, classes will be face-to-face through Thanksgiving. But then students will not be returning to campus after Thanksgiving break, but instead everything and the exams will then shift to remote. Again, a number of different schools had moved up their calendars to start earlier and end before Thanksgiving. We only have 9 instruction days after Thanksgiving, so having a lot of people leave and then return to campus seemed to pose a significant amount of risk. So rather than take that on, the decision was made to go remote. Also, there will be, again, across the system, but also in Madison, restrictions on larger lectures. More of the larger lectures will be moving online or remote, and then we'll have smaller face-to-face discussion groups breaking off from the larger lectures. Another area of concern, so I have a son who just finished his freshman year at Madison. So another concern for us was campus living. Dorms will be open. They will have some perhaps reallocation or restriction on capacity. I think they said they're looking to have no more than 2 students per room. And there will also be some changes in dining halls to move towards more of a grab and go takeout rather than congregating in large facilities. So again, things will certainly look different from last fall. But we will have students largely back on campus, and most instruction will be face-to-face, it looks like, in the fall.
Well, good. It's certainly resuming some new level of a norm.
Yeah.
With that, I would love to open up some additional questions from the audience. It looks like some are already rolling in. Feel free to please use the chat Q&A functions here, or send Tracy and I questions. We'd love to keep digging in. Professor Williams, one of the initial ones that came in was related to small business and what type of monetary policies could be enacted to help those, whether that's existing businesses coming back into the new norm or startups looking forward.
So particular policies geared towards small business. Yeah, so like I said, the PPP was the main program which has been enacted. There have actually been changes in that program over time. There was questions about whether businesses would be able to spend the money in time in order to qualify for the forgivability of the loans. There's been relaxation along those lines. I think there's interest. The first wave of PPP went very quickly. The second wave seems to have gone, second tranche seems to have gone slower. If that were to be exhausted, I think there would be interest in re-upping that, adding more funds there. Some additional things in particular that we could do at the state level would be to, the WEDC has had some small business grant programs. I think we could step that up a little bit. We've also seen over time, there have been increasing regulations and amount of essentially just paperwork involved in opening a new business. I think not just for the pandemic, but for the long term, anything we can do to ease that process and lighten the regulatory burden could help, not just, again, in the near term, but in the long run to help establish new businesses, which are really the driving force of most employment growth these days.
Certainly. On a federal level, we have a question coming in about the payback on all of the stimulus funds. What conversation have you been part of? What have you seen on that topic?
The payback on, I'm sorry.
On all of the federal stimulus monies that have been spent, whether that's through the stimulus checks or unemployment or PPP, what discussion has there been around payback of those numbers?
Honestly, very little. yeah, the deficit has really, the federal deficit has really just exploded.
Mhm.
And the debt to GDP ratio, which had already been increasing over the past couple of years with increased spending, but also tax reductions, even in a time of relative boom. That debt to GDP ratio is now looking like it's going to hit roughly 100% within the next year or so. Which has traditionally been kind of a threshold where people start to get concerned about the quality or the ability to hold the debt. The US, on the other hand, has been able to and continues to be able to borrow at quite low interest rates. So it doesn't seem like the market is ready to dump the debt anytime soon. Again, it's always easy to say that, things are stable until they're not. So at some point we will hit up against these thresholds. But to be honest, there hasn't been a lot. I mean, I think there's been some reluctance now in continuing to expand government spending as the economy starts to recover. But there's been relatively little discussion about actually paying down the debt. Certainly looking forward, it's going to have to be some combination of lower spending, higher taxes, or so-called financial repression, which is essentially pushing people into holding government securities instead of other securities.
That is a whole nother level of conversation, but to keep it in line with the audience today, how about the follow-up question to the government spending, which is inflation? What can we anticipate on that front?
So that's certainly always a concern. It was also a concern in 2008, following the 2008 recession. We saw, vast expansion of the money supply coming through the Fed, expansion of their balance sheet. The Fed is, we've talked mostly about the fiscal side, but the Federal Reserve has also been very active throughout this throughout this pandemic in lowering interest rates. Now, just recently, this was announced a long time ago, but just now they're expanding their so-called Main Street lending program, where the Fed will be directly purchasing investment-grade corporate bonds, which is, again, something they haven't done previously before. So there's going to be a vast expansion of the monetary base. Anytime you see that, that certainly opens the door for the possibility of inflation. The bigger problem over the last several years, though, has been the Fed has undershot their inflation target persistently. That doesn't mean there isn't an increased risk now, but it doesn't seem to be imminent. Again, the Fed has a number of levers. They're paying interest on reserves, so they're able to kind of regulate the speed at which increased money gets translated into increased economic activity. So again, I think there's a risk. Certainly, historically, anytime governments have taken on large debt burdens, to the extent that those get repaid, it's often done at least through a combination of higher inflation. So I think, over the longer term, it's a risk, but I don't think it's anything imminent.
Okay. The federal government of the United States approached how to manage through this pandemic differently than other governments internationally have. A penny for your thoughts on how that was addressed, how we compare to others, and how the U.S. government will be interacting with other nations moving forward.
Yeah, so I think one of the main contrasts has been with what's happened in Europe, particularly on the employment front. Right, so we've seen a vast expansion in unemployment, and the federal government has stepped in to provide expanded unemployment benefits. The primary programs in Europe and Germany is perhaps foremost in this, is the governments there have directly provided subsidies to businesses to keep people on the payroll. That, you know, in some ways, that's kind of, they end up being the same thing, the government providing support for labor. The benefit of the European approach, I guess, would be that the workers are more likely to stay attached to the businesses. Unemployment hasn't spiked as high, and therefore, as they come out of the pandemic, they're perhaps able to ramp things up more quickly. Again, the hope here in the US was that the unemployment would be temporary and many workers would return to the firms that they left. And we certainly have seen a fair amount of that. But I think we're also likely to see a significant amount of displacement there. The counterpart, or the downside, I guess, of the European approach is, when do you stop subsidizing the employment of workers? Once these government support programs get put into place, it's often difficult to dial them back. So there's kind of a question of the permanence of the program as well.
Certainly.
So pluses and minuses on both sides, I guess.
As always, right?
Yeah.
Last but not least, again, to be respectful of your time, we would love for you to pull out your crystal ball and give us your thoughts on what things in Wisconsin and even nationally look like 12 months from now.
Okay. So throughout the pandemic, March into April, I think all of the surprises economically were on the downside. Things were actually quite a bit worse than people realized, than people forecast. So I think, forecast for second quarter GDP started off, consensus was like minus 10%, then minus 20% now. The consensus is going to be something closer to minus 45 to 50%. So the flip side, though, I think, is we've seen more surprises on the upside of late. So I have actually become relatively more optimistic over the last couple of weeks, seeing things come in than I was earlier. So I do think we're in store for a period of elevated unemployment. But whereas before I was thinking, we'd be in double-digit unemployment rates, well into perhaps the end of next year, I think it'll be maybe something more like 7% or something like that. Again, still high in relative terms, but down quite a bit from what I'd thought earlier. So, overall, over the next year, I think, again, we'll see a relatively rapid rebound over the rest of 2020, then slower growth going forward. Again, continued reductions in unemployment. But again, it will probably take until, the end of 2021, maybe into early 2022. I mean, we were at historic lows, right? 3% is an anomalous unemployment rate. I would expect we'd get down to, maybe 6 or 7% relatively quickly, but then it would take a while thereafter.
But dare I call this tempered optimism?
Yeah, it's certainly, like I said, both consumer spending, economic activity, kind of the rebound has been more rapid than I expected. Of course, there's lots of things that could still go wrong out there, lots of potential shocks, but nonetheless, I think at least so far things have gone. The recovery has gone more rapidly than I anticipated.
Well, great. Thank you for leaving us on a high note there, and thank you also for your time today. Your input, your wisdom, and your willingness to take the time with our group is sincerely appreciated. So we look forward to continued discussions with you in the years ahead.
Okay, great. Thank you. I was happy to join you.
Thank you. All right, Tracy, unless there was anything else, thank you everyone for joining. Again, thank you, Professor Williams, and we will look forward to chatting soon.
Okay, great.
Be well. Thank you.
Bye.